All right, it's time for the morning show of yours truly, Dex the Algo Capitalist. And we have some interesting developments today. For the first thing, we see that there is a lot of market volatility this morning. And believe it or not, it's all cap. There's absolutely nothing to see here. Remember, I told you weeks ago that the longer a rally or sell off persists without stopping, without a pullback or correction, once a pullback or correction comes, it has all the earmarks of looking like a monster crawling from under the bed or out of the closet. It's scary. It looks monstrous, but it's really not. It's just that you've gone so long without a pullback or a significant correction, and you've gone so high in a bull market that any kind of a pullback, sell off, or correction will look like it's the end of the world. But in all reality, it's not. It's just smart people taking some profit off the table and waiting for the next entry point to get long the market. That's what's happening in Bitcoin. That's what's happening in Ethereum. That's what's happening in the Dow, the S&P, the Russell, the NASDAQ, gold, and silver. All of these markets I just named to you are preparing themselves to head fake and move higher. Now, it doesn't mean we don't have another day or two of, the sell-off, but I'm here to tell you, the bull market is not done. The bull market in Bitcoin, the bull market in Ethereum, the bull market in the Dow, the bull market in the S&P, the bull market on the NASDAQ 100, the bull market on the Russell, the bull market in gold, the bull market in silver is not done. All right? It's not done. So those mining stocks that are positioned well and are managed well should be able to get a lift from the next leg up in gold prices. Same thing with the silver miners. Those organizations that are run well and have better margins will also get a boon from the next leg up in silver. All right. Just something to think about as we're moving forward. I want you to think about this. Okay. Now, as we said, the US dollar index is down 31 pips at 105.54, struggling to hang on to that 106 handle. Therefore, the euro is up 41 pips at 107.58, pound sterling up 64 at 125.21, and the Aussie is up 20 pips at 65.24. Bitcoin futures are up $690 right now at $64,565. And Ethereum is up $30 at $3,162.50. Crude oil futures are down 24 cents at $82.57 per barrel. Nat gas pretty much unchanged at $1.98. And gold futures up $4.20 an ounce, trading at $2,342.50 per ounce. Silver is down a penny at $27.33 per ounce. And we have copper up a nickel at $4.51. Dow futures down 483 points at 38,197. The market had dropped in the overnight market down to 37,944, and the market has since recovered from that. The overnight high was 38,638, so we're still down hundreds of points from the overnight high, and we're off a couple of hundred points from the overnight low. This is just a wide trading range. Nothing really to see here. S&P 500 futures are down 43 and a quarter points this morning at 5,064 even. It had rallied in the overnight market to 5,082 and three quarters, and it fell to a low of 5,022 and a quarter. That is quite the rally off of the overnight low, if I may say so myself. E-mini NASDAQ 100 futures are down 177 points, trading at 17,488. The market had rallied to 17,525, and in the overnight market, it fell to 17,308. That is quite the rally off the overnight low. Russell futures down 23.8 points and is trading at 1982.9. The overnight high was 2024.80, and it fell to a low in the overnight market of 1965.70. What is driving all this volatility? Well, Meta disappoints. The social media giant posted its first quarter earnings report after Wednesday's opening bell, and its stock tumbled in Thursday's pre-market. CEO Mark Zuckerberg laid out a plan to splash the cash on AI investments, but that didn't distract investors from Meta's lackluster revenue forecast. Amazon has suspended new U.S. green card applications for foreign workers. According to a leaked memo, the company put the applications on hold for the rest of the year. It could be a sign Amazon is concerned about uncertain labor market conditions. What does Amazon know that everyone else doesn't? Why is it so hard to prove you're not a robot? Capture tests have been around for years, but they've become increasingly difficult and annoying recently. There's got to be a better way to prove you're actually a human being. I have to admit, they are extraordinarily annoying. And even if you do it right, it'll still say, no, we're unable to get you logged in at this time. It's just annoying. Google, once again, is dictating the future of the online ad industry. Google's latest delay in eliminating cookies, announced Tuesday, has the rest of the industry frustrated. Experts say the delay's outside effects underscores how powerful Google's influence has become. No kidding, you don't say. It's the number one search engine in the world next to YouTube. So, yeah. Private equity firms are making power plays in sports. As teams embrace outside investors, firms like Apollo, Blackstone, and KKR are funneling money into sports. Yeah, there are about 20 firms moving into the hot space, as well as leading deal makers helping investors get a piece of the action. McKinsey is in hot water. The Department of Justice is investigating the consultancy for its past work and advising opioid companies about how to boost their sales. The Wall Street Journal reported on Wednesday McKinsey has long been under scrutiny for its work with various drug makers and has paid nearly $1 billion to all 50 states, Native American tribes, local governments, and other groups to resolve a host of lawsuits without admitting wrongdoing. Yeah, again, the power of the briefcase, the power of the purse. Hit someone over the head with a large enough briefcase stacked to the hilt with money, and you can get what you want. In other news, Jeffrey's CEO sold $65 million in stock to buy a yacht from a client. I'm sure there's no impropriety there, right? Legal woes pile up for Trump allies. Giuliani, Meadows, and more indicted in Arizona election interference case. Sundar Pichai admits the generative AI boom took Google by surprise. And what if no one wants a cheap Tesla? The TikTok divest or ban bill is a First Amendment disaster, but it may still stand up in court. We talked about this yesterday, did we not? Say goodbye to the U.S. Constitution and the Bill of Rights. They've been replaced with the Bill of Privileges and Permissions. Now you can put your Botox on a firm. Private equity is getting into special education business. It's not all going smoothly. You don't say. New data reveals the top ways influencers get brand deals, how long they last, and how many are needed to make a living. I was LinkedIn's first head of HR. Pips don't work. There's a better way to help struggling employees. S&P 500 is at risk of crashing 44% and selling early could pay off, says elite forecaster. Whatever. Today's earnings is Alphabet, Microsoft, Snap, among other companies. Today is the first round of the NFL draft. The U.S. Supreme Court hears former President Donald Trump's immunity claim in the 2020 election interference case. The big story this morning, however, is a little bit different. Or could we say a whole lot different? Yeah, I know. I know. I know. I know. I know. But we got to do what we got to do. We got to go there. Biden calls for 44.6% capital gains tax rate, highest capital gains tax since its creation in 1922. Yeah. Yeah. And don't forget to add the state capital gains tax in addition to this. The Biden combined federal state rate would exceed 50% in many states. That's right, you heard me correctly. President Biden has formally proposed the highest top capital gains tax in over 100 years. Here's a direct quote from the Biden 2025 budget proposal. Quote, together the proposals would increase the top marginal rate on long-term capital gains and qualified dividends to 44.6%, end quote. Yes, you read that correctly. A Biden top capital gains and dividends tax rate of 44.6%. That is absurd. We talked about this yesterday, man. We talked about this. The U.S. government has gone Tony Montana. It's gone straight gangster on you. The United Mafia States of America. You got to now pay protection money to the state and to the Fed. You have a silent partner you didn't know about. They want to take 50% of your investment gains now. It's bad enough they're taking 50% of your income tax. Now they want to take an additional 50% of your investments, your long-term investments. This has got to stop. This is why I say you have to get these people out of office. Every Democrat and every Republican, period, in all 50 states, get them out of here. Or this is only going to get worse. Under the Biden proposal, the combined federal state capital gains tax exceeds 50% in many states. California will face a combined federal state rate of 59%. New Jersey, 55.3%. Oregon at 54.5%. Minnesota at 54.4%. And New York State at 53.4%. Worse, capital gains are not indexed to inflation. So Americans already get stuck paying tax on some gains that are not real. It is a tax on inflation, something created by Washington and then taxed by Washington. Biden's high inflation makes this especially painful. Many hardworking couples who started a small business at age 25 who now wish to sell the business at age 65 will face the Biden proposed 44.6% top rate plus state capital gains taxes. And much of that gain isn't real due to inflation, but they'll owe tax on it anyway. capital gains taxes are often a form of double taxation. When capital gains come from stocks, mutual funds, or stock ETFs, the capital gains tax is a cascaded second layer of tax on top of the current federal corporate income tax of 21%. Biden has also proposed a corporate income tax hike to 28%. You people better wake up and get these bums out of office before they completely decimate the United States of America, if they haven't already done so already. This is why I say you should have been did it. No one listens. You wait until it's too late. You wait until the boot is already on your neck, and then you want to do something. You're like Day Day and Friday. He wants to break bad after Ice Cube was fighting the Santa, after Skinny Santa jumped out the window. Now Day Day wants to break bad. But where was he when Ice Cube was fighting the Skinny Santa in the living room? And when Skinny Santa was beating him with the Christmas tree, where was he then? He wants to come at the last minute and break bad. It's too late for that. And that's only this is only the half of it. Do you know what else they're preparing for you? They're preparing something that the market has not priced in. Everyone's, sitting on eggshells waiting for the interest rates to come down. But I'm sorry to burst your bubble. It's going the other way. Prepare yourself for a Volcker-like series of rate hikes, ladies and gentlemen. That's right. What if the worst interest rate is yet to come? Until recently, the prevailing wisdom held that the Federal Reserve would start chopping interest rates sometime this year. At first, it was 7 rate cuts, then 5, then 3. Now it's just down to 2 rate cuts. The question of when this happens is a moving target. First cut was in March, then it was June, now it's September. Wall Street is even considering the possibility that there won't be a rate cut until March of 2025. The federal funds rate currently sits within a range of 5.25% to 5.5%. The last time the Fed raised rates was in July of 23, meaning that rates have been left unchanged for 6 of the last 7 Federal Open Market Committee meetings. Now, the high federal funds rate, also known as the prime rate, has trickled down to U.S. Treasuries and the U.S. dollar. The 10-year Treasury yield currently sets at 4.6% and appears to be heading toward 5%. The U.S. dollar index has been climbing all year and is currently oscillating between 105 and 106. What's the Fed waiting for? In a word, inflation. The Fed needs inflation to come down to its 2% target, but inflation isn't dropping. The March Consumer Price Index inflation print made public on April the 10th was 3.5%. In February, it was 3.2%, and in January, it was 3.1%. Persistent inflation, ladies and gentlemen, and the weird phenomenon of several economic indicators all rising in tandem has us looking to history for answers. We've already shown that inflation, the US dollar and bond yields are climbing. Normally, when the dollar and bond yields rise, gold falls. But gold is hitting record highs and is currently trading over $2,300 an ounce. When I first started out doing the Wall Street gig, gold was at $250 an ounce. Now it's thousands of percent higher. The gold price is extremely sensitive to the US dollar and interest rates. When bond yields minus inflation go negative, as in negative real rates, it's usually a positive signal for gold. But real rates have been positive for months, yet the gold up leg continues. What gives? We've shown that the central bank gold purchases are the main price driver, and more recently, institutions and wealthy individuals are, sprinting toward gold markets. But the retail investor is not yet invested in this gold bull market because more funds are flowing out of gold ETFs than in. Copper, a barometer of global economic growth because it has so many industrial uses, is also having a moment, rocketing from $3.76 a pound at the beginning of February to the current level this morning of $4.52 after spending most of 2023 under $4. Again, this shouldn't be happening while the US dollar is strong. All right. When inflation was hitting 40-year highs back in 2022, many people were compelled to look back in history at when this last had occurred. In 1979, the U.S. Federal Reserve Chair Paul Volcker faced a serious challenge: how to quell inflation, which had been racking the economy for most of the decade. The prices of goods and services had averaged 3.2% annually since World War II. But after the 1973 oil shock, they more than doubled to an annual 7.7%. Inflation reached 9.1% in 1975, the highest since 1947. Now, although prices declined the following year, by 1979, inflation had reached a startling 11.3%, led by the 1979 energy crisis. And in 1980, it soared again to 13.5%. Not only was inflation going through the roof, but economic growth had stalled and unemployment was high, rising from 5.1% in January 1974 to 9% in May 1975. In this low growth, hyperinflationary environment, we had stagflation. Volcker is widely credited with curbing inflation, but in doing so, he is also criticized for causing the 1980 through 1982 recession. He did it using the same playbook as the current Federal Reserve by raising the federal funds rate, except he was way more aggressive. From an average 11.2% in 1979, Volcker and his board of governors, through a series of rate hikes, increased the federal funds rate to 20% in June of 1981. This led to a rise in the prime rate to 21.5%, which was the tipping point for the recession to follow. Usually, the Powell Fed is compared to the Volcker Fed. But what if the proper comparison isn't to Paul Volcker, but his predecessor, William Miller, who served as Federal Reserve Chairman from 1977 to 1979? In a way, the comparison is more fitting because Miller is considered to have gone too easy on inflation by refusing to raise interest rates to quell demand. He left the dirty work to Volcker. Maybe Powell, like Miller, hasn't raised rates enough, and he will go down in history as following too dovishly of a monetary policy. Perhaps another more hawkish Fed chairman is waiting in the wings to do his dirty work. So let's take a look at what Miller did and didn't do. First, William Miller was appointed chairman of the Board of Governors of the Federal Reserve by President Carter in 1977. He took up the post on March the 8th of 1978 and served until August the 6th of 1977. Previously, Miller was a director at the Federal Reserve Bank of Boston. As chairman at the Board of Governors, Miller became known for his expansionary monetary policies. Now, unlike some of his predecessors, Miller was less focused on combating inflation, but rather was intent on promoting economic growth, even if it resulted in inflation. Even if it resulted in inflation. Miller argued that the Federal Reserve should take measures to encourage investment instead of fight rising prices. He believed that inflation was caused by many factors beyond the board of control. So Miller left the board of governors after being appointed Secretary of the Treasury, where he served until January the 20th of 1981. We talk about the inflationary 1970s because if you turn to 2004, there was a paper published in the Journal of Economic Perspectives titled Choosing the Federal Reserve Chair Lessons from History. Now, authors Christina and David Romer noted that in January of 1979, when unemployment was at 5.9%, Miller testified that tight conditions in the labor market were a normal accompaniment of economic expansion and to date have not reached troublesome dimensions. Now, the current U.S. unemployment rate is 3.8%, just 2.1 percentage points away from the January 1979 5.9% unemployment rate. Now, Miller's Federal Reserve attributed high inflation to factors such as reduced supply of agricultural goods, increases in the minimum wage, and depreciation of the dollar rather than demand pressures. The latter is probably the biggest difference between Miller and Powell. Powell immediately recognized that a big part of the inflation, which grabbed a hold of the economy in 2022, was demand for goods and services exceeding supply as the United States and other countries powered out of the pandemic. That and money printing is what happened next. So the concern about inflation and wanting to reduce it was expressed by other members of Miller's Federal Open Market Committee. But as Romer write, their optimistic estimates of the natural rate led them to avoid seriously contrary actions. Miller testified the Federal Reserve, for its part, is continuing to pursue a monetary policy that aims at a reduction of inflationary pressures while encouraging continued economic growth and high levels of employment. All right. Now, Miller himself noted on a number of occasions real interest rates still appear to remain low by historical standards and thus continue to facilitate an expansion of overall demands. The effects of Miller's relatively expansionary policy, as well as the lagged effects of Burns' are obvious. The unemployment rate fell steadily in 1978 and early 1979, and inflation surged even before the oil price shock in the second half of 1979. So, where does that put things? Well, the 1970s has become known as the decade of failed monetary policy. The Great Inflation lasted from 1965 to 1982. That's a long time. That's almost 20 years. When President Nixon was inaugurated in 1969, he inherited a recession from President Johnson, who had spent generously on the Vietnam War and the Great Society, a series of social programs aimed at reducing poverty. Nixon, however, famously entered office as a fiscal conservative and left it as a free spending Keynesian. In 1972, for example, Congress and Nixon agreed to a big expansion of Social Security in a time for him to get reelected the same year. See how that goes hand in hand? You give the people a little something, something, right in time for the election, you get reelected. Now, according to Investopedia, the great inflation was blamed on oil prices, currency speculators, greedy businessmen, and average union leaders. Notice how Obama blamed oil speculators back in 2008. However, it is clear that monetary policies that financed massive budget deficits and were supported by political leaders were the cause, not speculators. Nixon's other economic about face was imposing wage and price controls in 1971. As inflation began creeping higher, Nixon temporarily froze prices. When his controls were lifted, prices bounced even higher into double digits. In 1971, Nixon served the US dollar's link to gold. He severed that. He did it on purpose. All right, he severed it, turning the dollar into a fiat currency. So we went from a currency backed by gold to a fiat currency. Now, Investopedia notes the dollar was devalued, and millions of foreigners holding dollars, including oil barons in the Middle East, with tens of millions of petrodollars, saw their value slashed. In 1972 and 73, Fed Chairman Burns started to worry about inflation, which by 1973 had more than doubled to 8.8%. By the end of the 70s, it was 12%. And by 1980, it was 14%. NPR notes that by 1983, inflation had retreated to just over 3%, but at the cost of about 4 million job losses during back to back recessions in the early 1980s. For the next 4 decades, that's 40 years, inflation wouldn't become a problem until the pandemic struck in 2020, followed by the war in Ukraine. In June of 2022, inflation reached 9% for the first time in 40 years. Let me rephrase this. Based on the actions and decisions that lawmakers made during the pandemic led to the reinflationary environment that we had not seen for 40 years. Capiche? Let's take a closer look at that period just before Volcker was installed as Fed chair, because we want to know if it resembles the economic conditions we are in today. The economy of the 1970s was a period commonly known as stagflation. Stagflation occurs when economic growth slows and inflation rises simultaneously. The economy was in a recession from December of 1969 to November of 1970, and again from 1973 to March of 1975. The Khan Academy notes unemployment rose by 33% between 1968 and 1970, while the consumer price index went up by 11%, folks. That is staggering. In 1 year, unemployment nearly doubled to 6.1%, and by 1975 had surpassed 11%, the highest since the Great Depression. Consumer price inflation hit nearly 15%, and the dollar lost half of its value. $1 in 1970 was worth 47 cents in 1980. In 1973, the country was hit by an oil crisis. As mentioned, the oil rich nations of the Middle East were angered when the United States under Nixon devalued the dollar. When the U.S. supported Israel after a surprise attack by Egypt and Syria in the Yom Kippur War, the Organization of Petroleum Exporting Countries, or known as OPEC, extracted their revenge by imposing an oil embargo on the United States and Israel's European allies. The price of crude oil shot up to $11.65 a barrel, an increase of 387%, as the Khan Academy describes. Lines miles long formed at gas stations. The United States consumed 1/3 of the world's oil, and its citizens quickly discovered just how much of daily life depended on cheap oil. Families living in far flung suburbs depended on automobiles to get everywhere. Even after the embargo ended in March of 1974, prices for oil remained about 33% higher than they had been before the crisis. When William Miller succeeded Arthur Burns as Fed chair in March of 1978, inflation was high and the country still suffering from the oil crisis. The CPI was 4.9% in 1976 and 6.7% in 1977. Wikipedia explains that while Miller identified inflation as the country's primary domestic challenge and the chief obstacle preventing full employment, he did not favor aggressive interest rate hikes that would jeopardize growth. The modest increase in the federal funds rate during Miller's term did little to rein in inflation. It's interesting to note that during Miller's tenure as Fed chair, the dollar's value decreased substantially. As Wikipedia states, in November of 1978, only 11 months into his term, the dollar had fallen nearly 34% against the German mark and almost 42% against the Japanese yen, prompting the Carter administration to launch a dollar rescue package, including emergency sales from the U.S. gold stock, borrowing from the International Monetary Fund, and auctions of Treasury securities denominated in foreign currencies. This proved only a short term fix. Although temporarily steadying the dollar, it soon resumed its fall. Stagflation, this combination of the stagflation and inflation was used increasingly during this time to describe the higher rate of inflation, which failed to spur the economy, even as the situation worsened. Miller insisted that contrary policies like an overly aggressive interest rate increase would not fight inflation, but rather encourage it while hurting the economy's growth. Sounds like today. To avoid a recession, Nixon pressured the Fed to lower interest rates. He fired the Fed Chair William McKenzie, and installed Arthur Burns as his successor in early 1970. So he fires William McKenzie Martin and installs Arthur Burns as his successor. Here is where we begin to see a similarity between the economic conditions of the 1970s and today in 2024. Nixon, like Presidents George W. Bush, Obama, and Trump, wanted cheap money, which meant low interest rates to promote growth and an expansion of the monetary supply to support government spending. Now, according to Federal Reserve numbers, M1 money supply grew from $228 billion to $249 billion between December of 1971 and 1972. The M2 money supply increased from 710 billion to 802 billion by the end of 1972. This helped Nixon win the 1972 election, carrying 40 out of 50 states. Think about this. It is something to think about. Now, prodigious government spending continued throughout the decade. The Heritage Foundation notes that despite tax collections rising nearly sixfold from the Johnson to the Carter administrations, spending increased to 19.7% of GDP by 1975 and kept going to 22.3% by 1982. The deficit even rose from $1.4 billion in 1964 to a staggering $79 billion by the time of President Carter's final budget. The Heritage Foundation says billions went to city scale housing projects and urban development, with mass public transits cutting swaths across urban moonscapes. The nation's railroads were bailed out, with passenger lines nationalized as government owned Amtrak. Millions of new welfare recipients were created, Social Security beneficiaries massively expanded, and Washington was abuzz with talk of a guaranteed annual income mirroring today's universal basic income. That's right, ladies and gentlemen. Universal basic income is not a new idea. It's been around since the late 1960s and 70s. Fast forward to today. According to the U.S. Government Bureau of Economic Analysis, as of the third quarter of 2023, total government expenditures of 10,007.7 billion is 36.2% of total annual GDP of 27,610.1 billion. How has the government paid for these expenditures? By printing money, of course, and issuing bonds, i.e., government debt. M2 money supply was about 1,450 billion in 1979, and it's currently set at 20,783 billion. That is just unbelievable. The government is running a cumulative deficit of $1.1 trillion so far in 2024, 46 billion more than the same period in the prior fiscal year when adjusted for timing shifts. Now, Investopedia reports the U.S. national debt continues to rise under the Biden administration, increasing $6.24 trillion since Biden took office in 2021, largely driven by COVID-19 relief measures. According to the Congressional Budget Office, Biden's American Rescue Plan will add $1.9 trillion to the already $34 trillion national debt by 2031. His bipartisan infrastructure spending bill is estimated to cost around $375 billion over the next 10 years. Biden's Inflation Reduction Act, which aims to invest in green energy initiatives and reduce healthcare costs, could actually reduce the deficit by $58 billion over the next decade, according to the CBO. However, new spending includes a $250 million aid package to help Ukraine in the ongoing conflict with Russia. That $250 million could be well spent here at home to, to provide housing for the homeless. Now, this figure is in addition to the already $75 billion in assistance already sent by the U.S. to Ukraine between January of 2022 and October of 2023. And there is almost $100 billion being voted on today in military aid for Ukraine, Israel, and Taiwan. Again, money that could be used to house the homeless here in the United States of America. Ladies and gentlemen, the U.S. has a very, 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 very big problem. And I think you all know how this is going to end. All right, folks, I really do hope that you got something out of today's morning show. I try to bring you information to not just, be a soundboard. There's so many people covering pretty much the same thing, but I try to bring you things with a different perspective, a different viewpoint, so that, mostly a bibliocentric worldview, but I just try to cover things and try to make it clear and clean, because there's so much weirdness out here as far as fake news and just people not really wanting to tell the truth and really go in. But we do that here. We go in. Remember, the system works if you work the system. Bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And on that note, I'm out. I'll see you guys back here this evening for the end of day watch list special Take Back Friday edition. If you haven't already subscribed, you're going to want to do that so you can be kept abreast whenever new material is dropping. Okay. Everyone be encouraged and have a wonderful day. And on that note, I'm out. Peace.